We don't have to make this, like I said, we don't have to make this really difficult or tedious. And you can see that absolutely this thing qualifies as high or extreme, rather, it qualifies as extreme volume. This is what we're looking for our signs of a reversal. Now we put this together with the fact that the market's at a high on a daily, the market's at a high on the weekly, and that the market is on a high based on the day. So we're getting this extreme volume reading as the market comes up, exactly where we anticipate weakness. Now, what do the breakout traders say? Well, the breakout traders are going to say, well, come on, you're nuts. The market's going to flood with volume and it's going to break out. Yeah, it might, but then it might have a false breakout. This spike up here could very easily be a false breakout. So, as we see the volume come in, it's a spike volume, it's extreme volume, it's at a high, it's near resistance, so then what do we do? Well, if you remember from the second disc, I talk about watching for the market pulling back on low volume. Now you can see here that the market is the very next bar. Well, let me back up here. Let me reiterate here. If this bar was buying, we can pretty much say that the market would be continuing to go up, right? There's more demand than there is supply. But we can see that the market did not do that. It pulled back and is now in the process of retracing. So you can see that the market, the volume dropped off on the next bar, which was down. And remember, down bar, because this bar's close is below the prior close. So low volume, down bar. Now what we want to see is that the market, as it moves up here, does not exceed this volume here. Very simple. You don't want to see the spike come in, volume come in, activity come in above the prior level. So if you're watching the market and you're looking for an area to go short, obviously this is outside of the range here, but we do have a prior high that we could possibly short. We could have actually a different set of pivot points based on a smaller time frame as well. But you're getting the point. As the market starts to move up here, we see that the volume is declining. We simply look for an opportunity to enter the market. Of course, this is where the lower time frame comes in. Here's a 10-minute bar. Here's the same spike. Here's the move down. Now you can see that volume is definitely declining. And even in this up move here, you can see that volume is declining. This is why a multi-time frame analysis is so critical. Because on the hourly time frame, it just looked like, well, the volume actually looked kind of high. But what's going on here? The volume started to get low on the bottom, or as the volume started to get high on the low, and then as price started to come up, what happens? Volume is declining. This is exactly what we want to see in order to short and take the market down, because the professional money is not behind this move. Remember, the theory here is that if professional money was behind the move, then volume would be going up, pure and simple. You would not see this declining volume as price is moving up. So again, we had our initial analysis with the pivot points, and we're simply looking for volume analysis to back it up.